Welcome to CAS Research. Before we begin, I'd just like to make a note that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. In this webinar, I'd like to explain to you a little bit more into the two essential key indicators to apply to your trading. Many people ask how these indicators work. In this webinar, we'll be focusing on the MACD oscillator, the advantages the MACD offers you, and how to use this simple indicator to improve your entry and exit levels. Also, we'll be looking at the RSI, which is the relative strength index of the free time period, on how it works, and also how to enter and exit your trade. The conclusion should be combined that these indicators and a set signal system for higher priority trading should improve and better your risk management. What you should expect to take from this tutorial is the confidence to easily apply what you've learned to your trading, how to use these techniques to find the highest probability trades, and feel more confident in analysing the markets quickly and efficiently. This workshop will be invaluable if you want to improve your trading strategy and learn how to become a successful FX trader. Now, for some of you that may not know, MACD is the moving average convergence divergence oscillator. Here is the MACD construction. Now, as you can see, the histogram equals the same distance between the MACD and the MAC signal line. This is how the market can actually generate a buy signal and sell signal when the lines diverge and converge. The MACD fluctuates above and below the zero line, and as the moving averages converge, as I mentioned, cross and diverge, does give you these movements. Because the MACD is unlimited, it is not particularly useful for identifying overbought and oversold levels. Here is another example looking at the daily dollar yen. Bullish divergence was first an indication that supported a buy signal. Here you have the MACD line and the signal line and the histogram. Now, as you can see with the MACD histogram, is that it bottomed out at the time when dollar yen spiked down towards 99. And as you can see, the market recovered slightly and then started to sell off back to 100. And in all that time, the indicator was actually climbing. And as you can see, there is at first bullish divergence. After that, you can see the market then posts a buy signal as it crosses through zero. And the next day, the market surges from 100 up to a high of 107.50. Now, the market topped out there purely for the fact is that we had a bearish outside range day. And then from the rejection from 107.50 is the market started to decline along with the indicator. And as the histogram declined, the market eventually gave us a sell signal when it cut through the zero. This confirmed further negativity in the price action as yen strengthened and the dollar weakened. Now, as you can see, we have a similar pattern like the first. The fact is that price went down like previously, and the indicator actually was rising at the same time. This again is bullish divergence. But in this instance is the fact that the market did actually give us a day before the actual rally from 100 to 104.30. And then eventually the market dropped away from that level and then gave us a sell signal back to 100. And then in October, we've got a buy signal, and the market actually, as you can see, did carry on from 101 on to 103. And if you look at the history, it actually came in a lot stronger as the time when Trump came into the Oval House. The relative strength index, also the RSI, was developed by Wells Wider as an oscillator to gauge overbought and oversold levels. The most important thing to understand about the RSI is that a level of above 70 indicates the market is overbought, and a level below 30 indicates that the level is oversold. It can therefore range between 0 to 100. The default look-back period for the RSI on the MT4 is at 14. But of course we can lower this, and I'd like to show you by lowering it to 3 how sensitive it is. But when by increasing it and decreasing it in different time frames that you might like to trade, whether it's going to be 1 hour or if it's going to be shorter time frame, or if you'd like to put it out to as far as 1 day. Here is gold using an RSI 3. Now, as you notice, I've actually widened out the parameters to 95 on the top side and 10 on the bottom side, because that seems to where the market bottoms out and also tops out. Now, when the market topped out back in April, you can see that the gold peaked around 1,295, and then the downtrend began. And also, as you can see, there was divergence as the two prices posted two lows and a new low. The indicator didn't actually confirm this, and we got a sharp turnaround. Then we saw from the divergence the market snap higher, and the bull trend was established around 1,220, and then the market rallied all the way back up to the recent high of 1,295. But before then, you can see the market did top out briefly just above 1,262 and dropped back $20 before turning around and staging another bull move. Also to take note that I've put in a midway point. Now, when the midway point holds, relatively tells you the market's in a positive indication to a bull or bear trend. In this case, is that the market broke up, it fell back to test it after the market peaks around 96, and then as you can see the pullback rebounded a few times, and then on the last attempt the market stages a rally and peaks up to that high that I just mentioned at 95. Then the market turned back into a bear trend and tumbled all the way back until it reached 10, which told you the market was oversold. And then from 1,240, he rebounded back to 60. And then again, you can see we've got divergence. And the bullish case did come in clearly, and the market gave us a couple of days to get in before the market accelerated to the upside, away from 1,200 up towards the region of 1,260. So what you can see from this is that when the markets top out, and you're using this example of a free time frame on dailies, is that when the market gets above 90 to 100, you can see when the market is telling us to either take profit or even take part profit, or if you don't have a trade, maybe look to establish a short trade. And then when it breaks for the midway point, confirms the sell-off or the rally. And then when the market bottoms out beneath 10, it gives you an indication that the market is showing us some signal that there is a reversal coming. And a course correction does happen. And also when we see bullish divergence just recently back in June, July, is the market did snap up from 1,200 to 1,260 before topping out. And you can see here the market decided from not quite getting there at 96, it did drop back and then paused at the 50 point. So it's very straightforward. It's not hard to work out exactly what it's telling you, but using this time frame does give you great opportunity to get in the market at the right times and get out at the times when it's telling you when it's oversold, overbought, or showing you divergence. Well, that brings an end to our tutorial. Thank you very much for joining me. I hope you find this research useful to your trading.